All right, last topic for tonight. We're going to talk about the last source of gross income that you'll see tested on the quizzes and shown in the homework, and that's Social Security benefits. So Social Security benefits can be included in gross income. The determining factor will be the computation of the taxpayer's adjusted gross income from other sources. So if you have a taxpayer who has multiple sources of income and that those sources of income exceed a certain level, then some of the Social Security payments could be included in taxable income. Whereas if a person is below this line for the adjusted gross income plus some other items, then the person does not need to include Social Security income in their gross income calculation. So benefits for Social Security is the taxpayer's ability to pay. The amount of benefits considered to be recovery of the taxpayer's contribution or recovery capital. So what does this mean? Up to a maximum of 85% of Social Security income can be included in the computation for gross income that's taxed on the tax return. What's going to determine how much? So up to 85% maximum can be included. The taxability is based on the modified adjusted gross income, which is adjusted gross income. In adjusted gross income, we exclude Social Security, but we include any other sources of income, W-2 income, partnership income, gambling winnings, prizes, right? Annuity income, minus any annuity exclusions. Those are all included in income. We don't include Social Security for this modified adjusted gross income calculation. So all the other income is included. Plus we include a couple other things like the foreign earned income exclusion, which we'll talk about later. Don't worry about it if you don't know what that is. Plus any other tax exempt income, which we could talk about later as well, but that we'll talk about that in later chapters, but that could be income earned from like the municipal bonds, things like that. So if the modified adjusted gross income plus half of the Social Security benefits does not exceed $32,000 for married jointly or $25,000 for single, if you take the modified adjusted gross income plus half of the Social Security income, if you add those together and it's less than $32,000 for married and less than $25,000 for single, you don't need to include any of the Social Security income in the gross income calculation. However, if the amount of modified adjusted gross income, which is income from all the other sources, plus half of Social Security, that it exceeds the 50%, then some of that amount needs to be included in gross income to be calculated for the calculation of gross income to be taxed. So if a taxpayer's income exceeds the second threshold of $44,000, then 85% of the Social Security is included. So if modified adjusted gross income plus half of the Social Security benefit exceeds $32,000 for married filing jointly, and if it exceeds $25,000 for single, then half of that Social Security income is included in gross income for tax purposes. There's another step up threshold. If the same formula, which is modified adjusted gross income plus those other items plus the 50% of Social Security income, if that exceeds $44,000 for married filing jointly or $34,000 for single, then instead of 50% of Social Security income, you need to include 85% of Social Security income. If you go to the slides, there's some great examples here where we can see how much we need to calculate. So example A, we have a married couple, the adjusted gross income is $30,000, tax exempt interest is $3,000, and they have Social Security benefits of $10,000. So that the modified adjusted gross income, right, would be what? So let's do the calculation. We take the $30,000 plus the $3,000 plus the $5,000 minus the $32,000. So $3,000 of the Social Security income is limited to the 50% taxable rate. Down below for B, we have married with adjusted gross income of 40,000, tax exempt interest of 46, Social Security benefits of 10. So we take the 40,000, right, plus the 6, plus the 5, which is half the benefit, right, minus the 32, it comes out to 9,500. So 9,500 is limited to the 50% tax. So take a look at these calculations. It's in order for Social Security to be included in gross income, you need to take the modified adjusted gross income. You need to take half of the Social Security benefit, and if it exceeds a certain threshold, then a certain portion of the income can be taxed. And these examples A and B are a good example of that. So that's it for the videos this week. I'm available for questions, and I look forward to talking to everybody soon. Thank you.